hospitality industry faced many challenges as a result of the COVID-19 pandemic. But thanks to a strong business model and a solid strategy, Marriott has been able to flourish. We are WUNC Star Hills, and today we're doing a special coverage on Marriott International, providing you with an overview of the company, sharing information about its market position, doing an internal analysis, and lastly, giving you some recommendations. Now, over to Joey, who is reporting from Aspen, Colorado.
Thanks, Margarita. So who is Marriott? Marriott is the world's largest hospitality service provider, operating over 8,000 properties under 30 different luxury, premium, and select brand names in 139 countries. Headquartered in Bethesda, Maryland, and currently led by CEO Anthony Capuno, Marriott has 120,000 employees worldwide, with the vision of being the world's favorite travel company. In 2021, Marriott saw significant year-over-year growth as it continued to rebound post-pandemic, with $13.9 billion in revenue, $1.1 billion in profits, and operating margin of 7.9% with a RevPAR of $74.66, all well above industry averages. Marriott is organized underneath 4 different segments, with their luxury properties and brands, premium, select, and most recently introduced longer stays. All these properties and brands fall underneath the one Marriott Bonvoy experience. So what is Marriott Bonvoy? Marriott Bonvoy is Marriott's travel reward program. It's one of the largest in the industry with 160 million plus members, with strategic partnerships with Chase Bank, AMX, United Airlines, Hertz, Uber, and most recently Rakuten. Marriott Bonvoy is at the heart of Marriott's strategy. Their primary objective is to not just grow the number of members, but the overall level of engagement with the Marriott Bonvoy experience, looking to make Marriott Bonvoy an everyday part of their members' lives. Now over to Steve out of Bora Bora to talk about market position. Steve?
Thanks, Jerry. Now let's look at Marriott's primary competitors. The hospitality industry is broken into 4 main segments: luxury, premium, select, and longer stay. Now within each one of these segments, each of these companies have different sub-brands that offer different complements and levels of service depending on the clientele. Now looking at the luxury segment, you see that Hyatt is going to offer the Grand Hyatt, Hilton's going to offer the Waldorf Astoria, and those are going to compete against Marriott's St. Regis brand. In the select markets, we have Wyndham and International Hotels Groups, Holiday Inn, and Ramada competing against Marriott's Courtyard by Marriott. Now let's focus a little more in on the competitive positioning of these firms. So one thing you'll notice is all of these firms are horizontally differentiated. However, we see differences in the market segments that they focus in. So traditionally, Marriott has been focused in the premium and select markets, but we have seen them make a big push into the luxury and longer stay markets recently. Hyatt, on the other hand, has been looking primarily at the luxury and the premium markets, whereas Hilton primarily focuses on the premium segments with some offerings in both luxury and select. Now, on the other hand, we have IHG and Wyndham both competing within the select segments with a couple offerings in the premium as well. So let's throw it over to Joan for some 5-force analysis.
In the global hospitality industry, there's high buyer power, meaning consumers like you and me can exert downward pressure on prices, especially since this is a non-essential business and buyers have many options. With rising input costs, suppliers like food and beverage suppliers and wholesalers have medium power. Rivalry is increasing, and we're seeing some steady consolidation with major players, as well as an increase of rooms available. But brand loyalty remains important, which makes threat of new entry lower. Global hotels use economies of scale to reduce marginal costs. And finally, the threat of substitution is low. Consumers learned during the pandemic that they like to travel, but it's certainly something to keep an eye on. As we look at the macro environment, we see soaring inflation will potentially cut into revenue and profits as buyers make challenging trade-offs. Interest rates continue to rise, impacting the cash-to-cash cycle. This is a capital-intensive business, and they're exposed to the risk of depreciating assets. However, on the bright side, there's still a lot of pent-up demand for traveling for both business and leisure travelers. Tourism is projected to increase over the next 5 years, as the global economy continues to improve, especially outside of the US. Over to you, Ryan.
Thanks, Joan. It's a snowy day in Stockholm, and I'm reporting from the J Hotel, a boutique that Marriott acquired as part of the Starwoods merger. Marriott is a family business that focuses on their people. Retention is critical, so they utilize internal leadership programs, on-the-job training, and competitive compensation. Leveraging their scale, they drive down costs associated with vendors. They're also client-centric, leveraging their Bonvoy Rewards program to help create personalized solutions for customers. While competitive in a number of areas indicated here in green, Marriott could continue leveraging Bonvoy as a proprietary booking tool, finding ways to enhance their loyalty program through more strategic partnerships, which would then create even more customer delight. Now let's look at the numbers. RevPAR is calculated by multiplying a hotel's average daily room rate by its occupancy rate. Marriott is consistently higher than its competition. That said, the industry fell in total occupancy from an all-time high of 68% in 2019 to 44% in 2020. Occupancy is expected to return to pre-COVID levels, but the industry experts project business travel is going to remain low, meaning that target client is shifting. Now, if we look at the DuPont, we can see that Marriott has a distinct competitive advantage over the competition on their ROE. That said, Marriott has a high cost of goods sold, and they could also improve their turnover ratio. Marriott also has a high leverage ratio, meaning that equity as a percent of total assets is low. While they are making substantial revenue off of financed capital, which could be a good thing, they have a much more complicated capital structure compared to their competition, which is a concern for some investors. Now, over to Kamal.
Thank you, Ryan, and hello from Cancun. What a beautiful day to be out here, and what a place to talk about Marriott's external growth strategy. Behind me is City Express, Marriott's latest acquisition, first foray into the mid-scale, moderately priced hotel segment. So what kind of advantage do Marriott-owned hotel brands like City Express enjoy? Well, cost savings in booking fees, HR administration, and procurement activity. Capabilities, Marriott's brand recognition, and high-quality customer service. And finally, control. With acquisitions like City Express, Marriott has the opportunity to gain experience in new market segments. But let's not forget, City Express is not the only avenue of growth for Marriott. In fact, if we think about the growth strategy using McKinsey's 3 Horizon growth framework, they have so much more coming. Horizon 1 growth, 500,000 rooms in the development pipeline. Horizon 2 growth, they're starting to venture into new lines of business like yachts, home share, and of course, City Express, competing with the likes of Wyndham and Airbnb. And the elusive Horizon 3 growth, well, Marriott is partnering with Alibaba to create facial recognition technology. Their vision, seamless contact-free check-in for a Horizon 3 project. Will this project eliminate the need for human service in their hotels altogether? Well, I have my doubts, but we can only wait and see. That's all from me on Marriott's external growth strategy. Over to you, Margarita.
Thanks, Kamal. Marriott has a strong value proposition, and after our comprehensive analysis, we have 3 main recommendations. First, Marriott Bonvoy should be at the heart of its strategy, focusing on membership growth, active member engagement, and retention. Secondly, Marriott should double down on their technology investments, focusing on data analytics, hyper-personalization to cater to luxury and business travel. Lastly, they need to create strong differentiators with its competitors, leveraging their global presence, enhancing their Bonvoy brand, and focusing on bleisure, also known as business and leisure travel. To conclude, Marriott's profitable business model, a strong global presence, and brand reputation should position the firm for continuous growth and success. Reporting live from around the world, this is WUNC Star Hills. Thank you.
Well, before it was Winghead, but now I'm planning your itinerary. So thank you, Marriott Bonvoy, for having me. Thanks for looking after me everywhere I go, and I'll see you soon.